Hello, YouTube enthusiasts, and welcome back to Credit Control Series. Today, we're diving deep into what I call Financial Credit 3, the ability to pay. Grab your notes, there's a lot to cover. In this third segment, we'll decipher the maze of specifics that lenders look at, such as income, DTI debt to income, and credit reportability. Why do these details matter? The Code of Federal Regulations provides a hint. Ever wonder why a bank wants to know your income for a credit card? Income acts as a yardstick. A Google search of "when does a bank want to verify your income for a credit card" will give a written statement from Fool.com. According to the Motley Fool, it helps credit card companies decide on the credit limit they can offer. Imagine it as a trust factor. The more you earn, the more they trust you with their money. Flashback to my own journey, starting with the humble $500 limit. It felt limiting. I recall those initial days. The cautious spending. Some of you might remember starting with an even tighter $200 leash, but with time, knowledge, and some financial discipline, I've leapfrogged over that initial limit. Want to know how? Stick around for some nuggets of wisdom. But a spoiler, it's about more than just money. Financial institutions are intriguing entities, aren't they? For income affirmation, some might demand tangible evidence, like payslips or tax documentation, while others might simply trust your declaration. But rarely will they call up boss or knock on the IRS's door. An interesting tidbit: for secured credit cards, income proof often takes a back seat. Why? You're already providing collateral in the form of a financial deposit. They're more interested in your financial discipline than your paycheck. An impressive salary does not necessarily guarantee credit card confirmation. Lenders delve into your credit lineage, score, and that pivotal debt to income equation. To break it down, if you're raking in $16 hourly, amounting to about $2,560 monthly, and your debts munch away $850 of that sum, you're looking at a 34% DTI. The general recommendation: stay beneath the 31% threshold. But why restrict yourself? Go as low as feasible. But why stop there? The lower, the better. A low DTI tells lenders you're not living on the edge of your finances. A common myth: my income details are on my credit report. Your credit report is more of a financial report card, or better, it mirrors a financial performance analysis. It chronicles your debt management efficiency. It shows how responsibly you've been handling your debts, and how often you look for funds will cause those inquiries. They hang around for 2 years, and will be a 5-point reduction for each on your credit report. Bankruptcies, however, are more persistent, staying around for a decade. Yet, the bright side? Persistent efforts can rejuvenate tarnished credit. Back to our regulatory compass. The Code of Federal Regulation, particularly 1026.51. This legislative documentation sheds light on parameters like your prevailing and anticipated income, or assets when you're setting your sights on a fresh account. If you're aspiring for a credit boost, your issuer will meticulously assess liquid assets, specifically those that can be swiftly converted into currency. Assets such as savings, stocks, and bonds are prime examples. The core idea: they are seeking assurance of repayment. Before we get into the nitty-gritty, let's refresh our memory about why understanding the ability to pay is so vital. In the financial world, trust is paramount. The more lenders can trust you'll pay back your debts, the better your financial relationships will be. Lenders employ a multifaceted strategy to gauge your ability to pay, encapsulating your income, debt-to-income ratio, credit, lineage, and employment track record. The basics of income. Income is one of the most important factors lenders consider when assessing your ability to pay. Lenders want to know how much money you earn each month, so they can estimate how much you can afford to repay a loan or credit card. They also want to know how consistent your income is. A steady income is more reliable than an inconsistent one. If you have a high income, you're more likely to be approved for a loan or credit card with a higher limit. However, even if you have a high income, you'll still need to have a good debt-to-income ratio in order to be approved for credit. A brief narrative. Let me share a quick story. A friend of mine, Alex, had a high-paying job, but changed to freelance work. Even though he earned well, his inconsistent income posed a challenge. During his credit card application, underscoring the lender's emphasis on regularity. This illustrates the emphasis lenders place on reliability. They want to know that you can consistently make your payments, even if your income fluctuates. Income verification processes. Lenders employ diverse strategies to validate your earnings. Some may ask for recent pay stubs, while others could request an employment letter. And if you're self-employed, tax returns might be their ticket. It's vital to always provide accurate information, because dishonesty can spell long-term trouble. If you're ever asked to verify your income, be prepared to provide the necessary documentation. Factors beyond income. Income, while crucial, isn't the sole factor. Your current debts, credit score, and previous financial commitments play a role. The bank doesn't just want to know you earn well. They want to ensure you're responsible with what you earn. That's where your service account, credit score, and history come into the picture. Your credit score is a number that lenders use to assess your creditworthiness. It's based on your payment history, credit utilization, and length of credit history. Your credit history is a record of your past borrowing and repayment activity. It's important to keep your credit history clean and healthy by making all your payments on time and in full. Delving into debt-to-income ratio. Let's talk about the debt-to-income ratio, or DTI. This ratio is a significant indicator of your financial health. It's calculated by dividing your total monthly debt payments by your gross monthly income. A high DTI can make it difficult to get approved for credit and can lead to financial problems down the road. Aim for a DTI no higher than 36% or lower. Tips for improving your ability to pay. There are a few things you can do to improve your ability to pay. Increase your income, reduce your debt, improve your credit score, build a good credit history. If you're struggling to improve your ability to pay, there are resources available to help you. You can talk to a credit counselor or financial advisor. There are also government programs that can help you manage your debt. In conclusion, the ability to pay transcends mere monetary possession. It embodies financial sagacity. Whether you're at the onset of your credit odyssey or are retracing steps post-setbacks, awareness is your ally. Maintain vigilance and always hold the reins of your credit. Thank you for joining this discourse. Until our next rendezvous, bear in mind that the power to mold your credit destiny lies in your hands. Do show your support by liking, sharing, and subscribing for more insights. As our deep dive concludes, remember, the ability to pay is more than just having money. It's about financial maturity. Strategies to augment your ability to pay include bolstering your income, curtailing debt, refining your credit score, and fostering a stellar credit history. If challenges arise, resources are available for guidance. Thank you for tuning in. Until next time, and remember that you have the control to shape your credit future. Like, share, and subscribe for more.